Ladies and gentlemen, dear colleagues, on behalf of the European Commission, Director General for Regional and Urban Policy, as well as the European Investment Bank, welcome to this morning's FICOMPASS thematic seminar entitled Implementation of Grants Combined with Financial Instruments in a Single Operation. My name is Frank Lee. I'm Head of Division in the European Investment Bank's Advisory Services. And again, welcome to this morning's session. We hope to have a number of you joining us today. In fact, we had a fairly record number of subscriptions, and I already see more than 200 people have joined us for today, along with our star-studded list of presenters from the Commission, from the European Investment Bank, and of course, from a number of managing authorities and implementing partners. So welcome to everyone. If we move to the next slide, it just highlights a little bit the agenda for today. We will be with you for the best part of 2.5 hours. But to say that it will be a pretty packed session. There are a number of topics in this very important area that need to be covered. I will therefore be, as moderator, rather strict on the speakers, and I apologize in advance if I need to cut you off or tell you to hurry up. But unfortunately, I will have to do that if we need to get through all of the sessions on time. Nevertheless, we've left some good time, I think, particularly on the very more important areas for discussion. So hopefully you will gain a lot from today's presentation. We move to the next slide just to highlight that given the number of people attending, we unfortunately, though we want to encourage participation, we unfortunately will not be able to allow you to raise your hand and actually speak online verbally with us. And therefore, we encourage you to send any questions you have in through the Slido mechanism. We hope that most of you, if not all of you, know how to use this. The passcode you see there, hashtag FICOMPASS. We will obviously have this at the end of each of the sessions so that you have another chance to scan the code and get online. If you see a question on there that is similar or the same as the one you are wanting to ask, then obviously click on the like so that we can also try and prioritize those questions which are obviously preferred by most of you. I again apologize in advance that we probably won't be able to answer all of them. But nevertheless, we'll make a record of them and look at them after the event and try to come back to you on those. So, without further ado, I would like to just to also say that we are recording this event, and it will be made available on our website shortly afterwards, along with all the slides that will be presented by today's speakers. So, indeed, without further ado, let me hand you over to Mr. Jonathan Denness, Head of Unit in DG REGIO, Financial Instruments and International Financial Institutions Relations. John, the floor is yours.
Many thanks, Frank, and good morning to everybody. And I'm very pleased that we have such a large turnout today. Combinations between financial instruments and grants in the programming period 21-27 are now a lot easier, and the purpose of today's seminar is to give you all the information that we can think that you need to successfully implement combination financial instruments and grants in your programs. In the 1970s, the Dutch beer brand Heineken had a marketing slogan, and it said that Heineken refreshes the parts that other beers can't reach. That's what we think about combinations. We think that combinations reach projects that neither grants nor financial instruments on their own can really get to. And we think that they are a really powerful tool. And so this morning is really designed to equip you with the possibility to implement successfully. I had a look at some of the questions that you asked in the when registering for this, and I'd like to answer a few of them now. Rafał from Poland, you asked about, can you convert a loan to grant at the end of the programming period in 2023? No, because we're not talking about the 2014-2020 period. Here we're talking about the 21-27 period. Jan from the Czech Republic, yes, this covers JTF as well. So it's not just the RDF and Cohesion Fund, but it's also JTF. Marco from IPA, you asked what are the errors, caveats, risks? If we don't answer that question during the presentation, please ask again at the end, because I think we're going to be covering all of that. And finally, Beata from Poland, all EU member states can benefit. So it's not a specific member state, not confined to one part of Europe. Everybody can benefit. So before Frank cuts me off, I'll finish there, and please participate actively, and please use Slido because we want your feedback. Thanks.
Thank you very much, John. And indeed, I'll echo what you said at the end. We do encourage you to participate, despite the fact that there are a lot of us here today. But indeed, this is one of many components of this particular topic, which is our attempt to address all the questions and the details, and also raise as much awareness and outreach as we can on this extremely important topic. And thanks again, Jonathan. I think your slogan, refresh the parts that others can't reach, we'll put that on the website, I think, as the slogan of the topic of the day. Without further ado,
be careful of copyright, Frank.
Yes, exactly. As with everything in Fi Compass. So without further ado, I'll pass you on to Desmond Gardner, Financial Instruments Advisor in the European Investment Bank, to give you an introduction on the topic of the day. Desmond, over to you.
Yes, thank you, Frank, and hello, everybody. I just want to speak for a couple of minutes just to explain the Fi Compass Knowledge Hub process and how we've got the note. So if you have the next slide, please. Thank you. Yeah, so you'll see on the right-hand side, the large picture. This is the note that we've published, which accompanies today's webinar. It's been on our website since Wednesday, and you were sent a link, I think, in the email yesterday. So hopefully you will have an opportunity to look at that in the future, which covers the same areas that we're talking about today. It's actually the 7th Knowledge Hub report that we've published. The Knowledge Hub is a type of small event that we've developed, which allows us to look in depth at an issue. We gather a small number of experts from member states together, and we share and exchange our experiences and best practices alongside colleagues from the European Commission and the EIB. If you can have the next slide, please. The discussion is, yeah, can I have the next slide, please? Yeah, great, thanks. The discussions are done under what's known as the Chatham House rule, which means that people can share openly their experiences, and that can be used and repeated, but on a non-attributable basis. And the idea is that we get an open exchange and hopefully some of the trade secrets from some of the participants. So as a result, we get, I think, a note which is useful. It has actual experience and therefore provides practical support. And if we have the next slide, please. Then the note itself is not, of course, formal guidance, but I think as a result of the participation of experts from member states, it's probably much richer in terms of its content and hopefully usefulness. These are the key messages that are summarized in the note. I won't go through them all because you're going to hear from experts on each of these topics, but just to highlight maybe the first one, which is that the financial instrument rules apply from ex-ante assessment to audit. I think that was said at the beginning of the Knowledge Hub session that we held a couple of months ago on this topic, and hopefully we will explain that further as we go on. And maybe the other key message I'll pick out there is the fourth bullet point, which it is really for managing authorities to try to simplify processes to make sure that these combination financial instruments and grants can be implemented easily by the private sector partners. I will leave it there. Frank, I will hand back to you and wish everybody a good event. Thank you very much.
Thank you very much, Des. And indeed, we're doing well on time, so that's good to see. We're also pleased to say that we're almost at 300 online participants now, so welcome to some of you that have just joined in the last few minutes. So indeed, let's get into the meat of the topic. Essentially, we have a number of themes as was presented in the agenda, and section 1, which covers a number of those topics, is all around the design and setup of this combination as such. And to kick us off, I would like to introduce Ieva Zālīte, Policy Officer at DG REGIO, to walk us through some of the topics around the structuring of the grant component per se. And she will also be joined by Daniel Szczechowski, Head of Financial Instruments Unit in the Ministry of Development Funds and Regional Development in Poland. So welcome to the both of you. And Ieva, the floor is yours.
Thank you, Frank, and good morning all. So the managing authorities and bodies implementing financial instruments will be familiar with type of grants such as interest rate subsidies and technical support from the programming period 14-20. But in 21-27, we have new types of grants possible to be combined with financial instruments. And the discussion in the Knowledge Hub focused mostly on the possibilities of combining a capital grant and a capital rebate. And also, so for the purpose of this discussion, and you will see also in the paper, we use the following terminology to designate these different types of grants. So when we speak about the capital grant, we are referring to the non-repayable support provided within a combined financial instrument to cover the estimated viability gap or identified cost item of an investment project. So it means that the grant and financial instruments, they are provided either at the same time, or a grant can precede the financial product. So when we speak about the capital rebate, we refer to the conversion of a loan outstanding into a non-repayable support based on the fulfillment of predefined criteria, for example, performance of the investment, or for example, characteristics of final recipients. Next slide, please. So in the Knowledge Hub, the participants discussed when the grant component should be justified and planned within the financial instrument. So the first step is program level, and during the negotiations, the member states had to justify the form of support and describe their planned use of financial instruments. Further on, the ex-ante assessment then may go into more detail to analyze the need of the combination, possible types of grants, their percentages, and if the managing authority has done its ex-ante assessment already but is thinking about the combination, to justify this combined support of grants and financial instruments, it is possible to do it in a separate analysis. So the participants agreed that also this analysis should be done at the level of the financial instrument, because at that point the specific projects supported are not known yet, and justification can be done with regards to the setup of the financial instrument, taking into account program objectives and the benefits of having financial instrument and grant as part of the financial package. So some of the most common factors that were cited to be taken into account when considering whether the grant is linked and necessary for the FI operation, where possible payback analysis, for example, where the costs of the works will require excessive payback period, and then grant can be justified to ensure the product is both attractive to the financial intermediaries and final recipients. A viability gap coverage, here the need to cover financing gap for investments where they are not fully financially viable, and also the justification may be contribution to the policy objectives and achieving more ambitious investments. Next slide, please. Then the participants discussed how to avoid the double support when the financial product, for example, loan and grant is used. So when we speak about the double support, we speak about avoiding the EU paying twice for the same purpose. So in the workshop, the example of the guarantee instrument combined with grant was cited, and in the paper you will find also a numerical example. But just to demonstrate that, so if there is a funding agreement signed for covering both forms of support, committing a certain amount of the program resources for guarantee and certain amount of program resources for the capital rebate, then when the financing agreement is signed with the final recipient, the guaranteed loan will be given for the full amount of loan to cover the investment cost of the project. So the loan agreement will include also the triggers for the capital rebate. At the time and when the capital rebate is triggered and paid, so the capital rebate will be attributable to the grant component, and the eligible expenditure will attributable to the financial instrument, meaning the guarantee, will be reduced because the value of the underlying loan will be smaller. So in these situations, there is no double support because the underlying investment is supported partly by grant component and partly by guaranteed loan, which is smaller, and respectively the guarantee is also smaller. And for a scenario of loan, so again, here a single funding agreement is signed with conditions to trigger the capital rebate are included in the financing agreement with final recipient. So here, when the capital rebate is triggered, part of the loan will be transformed into a grant, and the loan part will be reduced. So the final recipient will not receive additional amount of grant. Thank you very much, and I hand over to Daniel. Thank you.
Yeah, good morning, everyone. Greetings from Warsaw. I would like to comment on the issue of the justification necessary for the grant part of the combined financial instrument. This issue was discussed during our previous meeting. And of course, obviously, according to the CPR, the justification for the grant part is compulsory. But the question arises when, where, and when establish this justification, when to check it, how to check it, why to check it, etc. So, as Ieva said during her part, the justification should be presented on the financial instrument level. So therefore, we can treat it as a general rule, as a general approach. Certainly, we can imagine the situation in which every single investment is checked for the necessity of the grant part. Perhaps in the case of some specific large-scale investments, for example, big infrastructure, it would be advisable, this checking on the level of the single investment. But in case of typical financial instruments, for example, portfolio guarantee with the large number of investments of relatively small or average value, it would be overcomplicated. It would be counterproductive. And definitely we should try to keep it simple, and it would be enough to present the justification at the financial instrument level, and demonstrate, for example, what policy impact, demonstrate in the operational program provisions, demonstrate what policy impact we want to achieve thanks to the existence of this supplementary support in the form of the grant part. For example, the managing authority intends to increase the number of investments in the specific area, which is crucial for the goals of the operational program. This is my comment to this part. Thank you.
Thank you, Daniel, and thank you also, Ieva, for the presentation on the slides. Maybe while we carry on, I can ask the colleagues to put up the slide again, just again for those that didn't catch it at the beginning, and you have a chance now to scan it in and pose the questions. So thanks, Ieva, for highlighting indeed we had a lot of discussions in the Knowledge Hub around this concept of capital grant versus capital rebate. I think you highlighted there the fundamental difference, that one starts off as a repayable component and transforms into a non-repayable component, which is the rebate element. The other one essentially is a grant from the beginning. So I think that's quite fundamental to assess those two types of interventions on the grant side. And thanks also, Daniel, for highlighting some examples of where this grant might be established and assessed at sort of a program level or across a number of projects collectively, as opposed to looking at grants individually, project by project. So I turn quickly to Des, my colleague. I don't know, Des, do we have any questions yet?
Yes, we do, Frank.
Yes, okay, great.
We've got, I think, 4 questions. I'll maybe I'll ask you them quickly. Somebody has asked, in case the grant is paid up front simultaneously with a loan, but still conditional to performance, shall it be regarded as a capital grant or a capital rebate? And then somebody else has asked about, what about the combination of grants and equity financial instruments? Those 2 questions. And then there's another 2 questions, which is about the mechanism, which somebody has asked, is it possible to use combined support if at program level the combination was not foreseen, but in the ex-ante there's a suggestion to use combination? So that's, I guess, about the program. And then finally, why would a bank be interested in taking part in an FI loan fund with a capital rebate? Can the bank so easily reduce the amount loaned to the final recipient? There's 4 questions. So thank you, everybody, for raising those questions.
Thanks, Des. We may come back to you to remind us of some of those questions. They're pretty technical. But I think maybe Ieva, on the first one, I understood that it's sort of, can you start off with what is a capital grant up front and have some sort of trigger, it seems, that might make it repayable. That was my understanding. And then maybe you also want to answer the question on, can we combine grants with equity? I think that was the second.
This is for me.
Ah, sorry, Daniel, for you.
Yeah.
So you have a first.
Okay, thank you very much for the questions. So if we speak about the first question of where the capital grant, so where the grant is comes first and then the loan follows. I don't exclude a situation where the grant component is linked to the performance, so of the entire investment. It is possible that at some point later the grant component is converted into a loan, because in the paper that was presented on one of the first slides in the paper on combinations, we speak about different type of possible combinations of grants and financial instruments. What I would like to highlight is that the most important thing is that we avoid the double support. So we shouldn't pay for the same investment twice. And maybe I can, so maybe Daniel can take then the question on equity, I think.
Yeah. Yeah, certainly. The majority of combinations of financial instruments and grants will take place in the case of loans and guarantees. That's for sure. But it doesn't mean that this kind of combination is not possible in case of equity or quasi-equity. It is possible to combine equity financing and grant financing. Of course, honestly speaking, I don't know any interesting scheme, any interesting concept implemented in Poland or in other European countries. But maybe there are some examples, and maybe some of you, I mean, the participants can share with us. But it is possible to combine equity and grant. I imagine that for example, in case of equity investments to the companies on a very early stage of development, the so-called pre-seeds investments, in some cases, the input of grants as a non-repayable finance can be advisable to incentivize the private investors to put equity financing from their side. So this kind of combination is certainly possible.
Yeah, I would imagine we may see this particularly in the area of sort of research and development and innovation. That probably would make sense.
Yeah.
On the third question and the fourth one, Ieva, maybe on the third one, I understand correctly this concept of combining at the program level. You want to pick that one up?
Yes, thank you. Thank you again for the question. So if I understood the question correctly, so if at the moment the program hasn't envisaged the combination of support, it's still possible to think about it and to design financial instruments providing combined support of grants and financial instruments in one operation. So there is the managing authority would need to change the program, amend the program, and if initially such combination was not analyzed in the ex-ante assessment, for example, it's possible to provide to analyze this link, the link and necessity of grant to the financial instrument in a separate document. So there is a lot of flexibility to add such financial instruments to provide program support through through combined support.
Yeah, indeed. And you mentioned in your slides as you say, the justification can happen at various points in time, whether it's in the ex-ante, as you say, up front, or through some sort of separate analysis later on. But as you say, it would require a change to the programs in order to allow for that to happen at a later stage. And the last question,
Frank, Frank, it's Des here. Just while, sorry to interrupt, we've just been asked another question related to the same topic, which is that if the need for grant is justified in the programme, is it necessary to justify it again in the ex-ante assessment? I hope you don't mind me asking that.
Yeah, no, that's a good follow-on, I guess. And maybe Ieva. So the question is, you know, if it's justified up front in the programme, do we need to re-justify in the ex-ante?
Well, the justification for the principle or the need for the grant support, it will carry on into the ex-ante assessment or in the separate analysis, because in the program the justification is broad. It states the intention for which type of final recipients the combined support will be provided. But to make the contribution to the financial instrument and to make an informed decision about how much of grant is necessary and linked, this will require further analysis and possibly also market testing to see how much of the grant component will be required for actual implementation.
Yeah, I would imagine that the justification in an ex-ante, as you say, would help to be more precise, and that would be probably more useful where we see this combination to happen on a sort of regular basis across a whole lot of small projects without the need to look at it on an individual project basis. The ex-ante could establish that across the program, fixed percentage of grant or whatever the case may be. But the last question on the why would a bank be involved in something like this? As far as I understood, is that right, Des?
It was just about, can a bank work with a capital rebate? Can it easily reduce the amount loaned to the final recipient?
Through a capital rebate.
Okay, I can start. Maybe Daniel can complement. So we think that the loans combined with capital rebate is the most attractive product from the bank's perspective, because what in effect it means is that the bank will issue a loan to the final recipient. So the only requirements are to identify in the financing agreement with final recipients the triggers for the capital rebate. And there the financial intermediary will follow the details in the investment strategy of the financial instrument, so what is agreed in the funding agreement. And when the criteria are satisfied and capital rebate is triggered, so that from the bank's perspective, it will be a write-off in their books of a certain amount, and the final recipient will continue repaying the remaining outstanding amount of the loan.
Yeah, I agree. For the banks, this kind of combination shouldn't be something very complicated. Yeah, because I think it can even simplify the process of paying off the loans, because at some part of the repayment period, the EU money, instead of repayments from the final beneficiary, this is the EU money that will, in one or two or three tranches, will repay the outstanding loan. So I believe that for banks it's a very, very good solution as well.
Thank you, everybody. I think that probably covers quite nicely this first topic, and we've had lots of other questions, so thank you to the people who are asking questions. I think they relate to future sessions, particularly the state aid ones, so we will hold those till then. But in the meantime, maybe we will move on, and I'll thank Daniel for his contribution, and maybe we will hear from you later, and thank you, Ieva. And I'll introduce Emily to present the next section on selection and funding agreement. Emily, floor is yours.
Thank you, Des, and good morning, everybody. So I'll try and guide you through the topics of selection and funding agreement and some of the highlights from the discussion that we had at the Knowledge Hub meeting. So if we could go to the next slide, please. And then I will pass to Aleksej, who will give his reflections. Whilst I'm waiting for the slide, great, thank you very much. So the first point that really came out of the discussion in this area was the need to make sure there is some flexibility in the ex-ante assessment. So it was recognised that the ex-ante assessment may identify a need for an amount of grant up to a certain percentage or perhaps a range, but that amount, that range, needed to have a little bit of flexibility, so it could be adjusted if following market testing, if following discussions with the financial intermediaries, there was a need to revise it slightly. The next point was really around the appetite of financial intermediaries to manage grants, and there the discussion focused on the need to really try keep things as simple as possible, and particularly in relation to granular portfolios, so where we have a large number of small projects. It was discussed that it was a good idea to keep the grant at a fixed or predefined percentage upfront, so the financial intermediaries had as much clarity as possible, and the systems that were needed could be as simple and streamlined as possible. The arrangements for managing the grant and the financial instrument in a single operation will be documented in a funding agreement, and we also discussed actually what might be included in there. So the funding agreement must include the conditions for providing the grant support, and it may need to cover the calculation methodology for the grant element. So if we are proposing to proceed on the basis of a fixed or predefined percentage basis, that would be in there. Or if there was going to be a flexible grant approach, again, that would need to be documented. If it's not possible to include that detail in a single funding agreement, because perhaps there are multiple financial intermediaries going to be involved in the deployment of the financial instrument, and it would just make the funding agreement too complicated, it is possible to use other legally binding documents to prescribe some of that additional detail. So as I said earlier, the discussion really highlighted the need for everybody involved in the administration and the development and deployment of the instrument to try and work hard to keep the administration of the grant as simple as possible, to keep everybody's lives as easy as it possibly can be. For that, there was a real, as I mentioned earlier, a real consensus that there was real merit in moving on the basis of defined percentages, so that the financial instrument was very easy to market. It was very understandable to the market. It was understandable to the borrowers, and importantly, it was very easy to administer by the bank or the other financial intermediaries, noting that financial intermediaries may not have had previous experience of managing grants in the past. As I said, the funding agreement will also include the specific arrangements for the grant management, and it must also include the arrangements for monitoring the percentage of the grants versus the financial instrument component, obviously taking into account that the grant component may take different forms. And importantly, where grant management responsibilities are split between bodies who will be implementing the holding fund and specific funds, so where there is a decision that the grant aspects should be managed perhaps at holding fund level, whilst the repayable elements of the financial instrument managed at specific fund level, the funding agreement should be very clear to reflect the specific roles and responsibilities of the different bodies, so that everybody has full clarity, and that should also cover aspects in relation to monitoring, reporting and control. So I think the big takeaways for me from the discussion in these two topics were the need to keep things as simple and straightforward as possible. And I think now I pass to Aleksej for his own reflections on the session. Thank you.
Yes, good morning. Thank you very much, Emily. I fully agree. And my key words for today's panel also are simple and clear. And that's actually my key objective working with a combined financial instrument for the moment. We are currently implementing combined financial instruments financed by Recovery and Resilience Facility. ERDF programs are still under development. I would like to pinpoint like two aspects. That's a first aspect would be the private sector. So usually private sector is being interviewed during the ex-ante assessment drafting process, and it is playing even bigger role when specific regulations are being developed by the respective ministries for approval of the Cabinet of Ministers. That's the case of Latvia. In those rules, the specific program details will be described, and this is the most challenging part from the point of view, simple and clear approach. For example, the loans are usually provided for the investment, including VAT, value-added tax. Thus, it should be clearly seen from the rules how capital rebate is calculated. The simple approach would mean that it is calculated from the total amount of the loan, including the loan part provided for the financing of the value-added tax. And there are many details like this which should be covered by the respective rules. The second aspect I would like to discuss or present, this is a great flexibility which is allowed by this new approach of capital rebates and capital grants. For example, internally, we are having discussions on how to provide technical assistance for the development of technical documentation. For example, for energy audit or for the development of technical documentation like drawings and so on. Traditionally, in our case in Latvia, capital rebate is set fixed at certain level, like 30%, 35% or 40% of the financial instrument contribution to the underlying investment project. But it seems that there is enough space for the technical assistance part, let's say even 100% of the respective loan. In this case, specific features should be incorporated in the program to check that cumulatively capital rebates does not constitute more than 50% of the combined financial instrument volume at the end of the implementation period. We are still developing this scenario, but this is very interesting exercise. And just the final remarks. It seems that adaptation to the combined financial instruments is taking time from our customers, from our partners, and now also from our side. We had to adapt our IT systems, our reporting systems, in order to incorporate those capital rebate elements to report on capital rebates. And this is still pending and ongoing process, even though our capital rebate programs have been approved in December, and we have started it in December last year. So it's still, we have spent 6 months working with the capital rebate programs, and we have still some questions to the ministries, addressing to the ministries and discussing them, the respective different features of the programs, like I mentioned, VAT tax, for example, as well. Yeah, thank you very much.
Thanks, Aleksej. Thanks, Emily. And apologies, colleagues. I was disconnected there for a short while. Wi-Fi, I think, crashed. But I'm back indeed. So we are running a little bit late, and the next topic actually is on state aid, and I think it's a very important topic. I want to make sure we have certainly enough time for that. But maybe just one quick question, if I may, maybe quickly to Emily and one to Aleksej. On Emily, should a managing authority have a single funding agreement for both the financial instrument and the grant, or separate ones? What's the verdict?
It depends. So yes, ideally there would be one, but I think we recognise that where there are multiple actors involved in the instruments, so where you have a number of different financial intermediaries, it may actually be quite complicated. So if there is a holding fund that's retaining some grant funding, management responsibilities and so on, you would need to adapt accordingly. But in a simple, straightforward combination, yes, there would be one.
Have it together, yeah. And Aleksej, you mentioned this challenge, let's say, for managing authorities in making sure that they don't surpass this 50% rule. I think you mentioned a few things that you were thinking about still. Any advice for other managing authorities on how to ensure this is sort of adhered to?
Yes, definitely. In our case, the most simple approach would be setting up the capital rebate, for example, at the level of individual project, and which is below 50%. And if there is more complex approach, actually, I would propose a discussion that there should be some additional money, additional funding should be reserved for specific cases when this 50% ceiling is not reached by the program.
Yeah. Okay. No, good advice. Thank you. And thanks again then to colleagues on that session. So indeed, let's move swiftly on to the next session, which is indeed a very interesting topic, state aid and the combination financial instruments. So for that, I'd like to introduce you to Mr. Joachim Keller, a colleague from DG Competition at the European Commission. Give us a short overview of the current rules and how they may apply to this specific situation. Good morning, Joachim. Are you there?
Good morning, everyone. From my side, happy to be here to give an overview about the state aid rules applicable to combined financial instruments. Next slide, please. And yeah, okay. So also from the state aid perspective, on the one hand, the financial instruments part that covers the most common financial instruments, so loans, equity, quasi-equity, guarantees. And then on the grant part, that is then anything which can assimilate it to a grant. So it could be a capital grant, capital rebate. There's a bit more specific case of repayable advances. So they could be seen as in financial instruments, but then they're also including a grant component. So that's why I haven't included them under the financial instruments here, as we will also see later in the presentation, the reason for that. But it's true, if they can be decomposed in a, let's say, basic financial instrument component, so a loan and the grant part, then also the amounts can be covered by stated rules. Please, next slide. So as an overview about, let's say, the two fundamental approaches of how to limit aid under state aid rules. So the more commonly used approach stems really from the fact that in the past often it was really about granting aid. So this is transparent aid approach where either a grant or where we can precisely the gross grant equivalent of an financing ex ante without any need to undertake a risk assessment. So this is applicable to a wide range of state aid articles, where then a maximum aid amount or aid intensity is defined. It's also applicable under de minimis. And here, the main approach is that the grants and financial instruments are then aggregated via a gross grant equivalent calculation. But then we have under JIBA also some specific state aid articles, so notably the one on 16, 21, 22, 39, but also InvestEU, where we don't rely on a gross grant equivalent calculation. But there we will have other limits, which I will explain in a minute. Next slide, please. Yeah. So with regard to the first approach, where we have where we calculate everything via the gross grant equivalent calculation, here we can, for the different financial instruments, there are methods stipulated in the JIBA of how we can calculate the gross grant equivalent. For example, for interest rates, for loans, it's the subsidy inherent in an interest rate, measured, for example, by reference to the reference rate communication, so where you can stipulate the market interest rate and then takes the differential to the actually charged interest rate and then calculate the net present value of these 8 installments over the lifetime of the loan. Similarly, for guarantees, here also for the market conform premiums of guarantees, we have the guarantee notice, where there are safe harbor market premiums for SMEs, but there's also the possibility for member states to have a notified guarantee methodology to produce market-conform guarantee rates. And here we can also then calculate the net present value involved in a guarantee by looking at the 8 installments in the subsidized premiums over the lifetime of the guarantee. Then we have also under the de minimis the safe harbor approach for loans and guaranteed loans, where we have a more simplified calculation than calculating the net present value of subsidized loans. Here we have the safe harbor limit, so that loans under a certain maturity and under a certain amount can be then equated to the de minimis ceiling, or any then reduction in amounts and maturity is then proportionally calculated as a share of the de minimis ceiling. Then as regards equity, quasi-equity, so because this transparent aid approach is meant to be simple, so that you can really ex ante determine the aid amount without further risk assessment, so that for equity and quasi-equity, we take just the nominal amount. So basically an equity is not treated differently than a grant. Then on the grants, the question also has arisen a couple of times. So for example, in the case of capital rebates, if the grant is conditional on certain events, that under stated rules, it's always at the moment the aid is awarded, and even if it's conditional, it still needs to be, let's say, accrues fully as aid. So even if the aid award is not certain in the future, but the possibility is created at the moment of grading, it must be accounted fully. So that's also in line with the principle of transparent aid, that we cannot go into any sophisticated risk assessment. Also similar to equity, where we also don't do an assessment of what are the expected returns on the equity. But also for grants, if they are paid out, even if they're granted, let's say now, but they are paid out only later, the grant amount can be discounted to the present value. So in this first approach, there's really within, let's say, a single state aid legal basis, if it stipulates a certain maximum aid amount, then by arriving at the summing up of the GGE of the financial instrument and the grant amount, we can then combine easily the instruments and have quite some degrees of freedom, as long as the GGE remains within the maximum. Next slide, please. Yeah, and then, as I said, there are these exceptions to the gross grant equivalent calculation. These are the financial instruments only state aid categories. So here I have focused on these articles 16, 21, 39, because they exclude grants. So here we can it's only loans, equity, quasi-equity, and guarantees which are covered. The reason is, so these articles have been designed as a 3-layered structure. So there's an involvement of financial intermediaries, there's co-investments of private investors, and here the eligible conditions have been designed around ensuring that it's neither the intermediary receives indirect aid, also that the aid that the private co-investors receive is proportionate to just incentivize them to invest, and also that the eligible conditions on the companies are in line with the policy objectives. And then there's also the limits on the notional amounts of financing to ensure that the overall aid amount remains proportionate. But there's no direct quantification of the aid amount. And then in these cases, if we want to give a combined financial instruments by using these articles for the financial instruments parts, we need to find another legal base for the grant part. And that brings me to the next slide, to the cumulation rules. Because then if I combine for the same measure 8 under different legal basis, the cumulation rule needs to be respected. And here I'm just running through different possible combinations. So for example, if you have 8 with identifiable eligible costs, then in principle you could give 8 on a different legal basis for the same eligible costs up to the highest intensity applicable under these applicable state aid rules. Probably a more practically relevant example is if we want to have give the combined instrument using, for example, Article 39, which excludes grants, then we can still give the grant part under de minimis, respecting the cumulation rule, so that the grant part can only be up to the de minimis ceiling, and the total amount, so the grant plus the financing, must be in line with the limits specified by 39. Next slide, please. Similar for aid without identifiable eligible costs, so that would, for example, for Article 21, risk finance aid. Here again, we can cumulate also with different GBA articles. For example, Article 22 also allows grants. So there could be a scheme where a grant of up to 500,000 is given under 22, and then up to 50 million or 16.5 under the revised GBA on the entire package can be granted under Article 21. Of course, the eligible conditions for companies needs to be respected. So Article 22 is more narrow. It's small. It's just small companies. So it's startups also in the first 5 years. So that also applies then for 21. Also in general, if a company gets aid under risk finance, it would still be eligible to get de minimis aid. But if the de minimis aid is part of the same risk finance measure, so a combined instruments of let's say a loan and the grant, then it would also have to respect the overall 16.5 financing limit, but you could give the grant of, for example, 200,000 under de minimis. I think I stop here with the slide, but happy to take any questions.
Yeah, thank you, Joachim. Before we get to the questions, we also have a colleague from Invega in Lithuania, Ieva Petkevičiūtė.
Yes.
Are you there, Ieva? Would you like to give us your reflections before we get into the questions?
Okay, so I would like to share Invega's experience in using GBA, Article 25, in combination of loan and capital rebate. Actually, previously, under Article 25, it's R&D. In Lithuania, more subsidies were used. And like 1 year ago, we introduced the measure we started to give loans for R&D projects. And in the same loan agreement, there's all GBA and 8 rules are respected. We calculate what amount of the capital rebate the company can receive, and also what amount of the loan the company can get. And these loans are issued for 10 years. So as we started it like 1 year ago, so we have like 10 loans, and our experience maybe is not so long, but nevertheless, we started it using budget money, and we plan it to use for the structural fund money. And in the initial contract, we calculate the amount of the loan and put some triggers when the company should achieve, when we can say that, okay, up to 20% of the loan could be treated like a capital rebate. But I would like to say that everything should be calculated at the beginning. So we while calculating state aid, we calculate with 20% of rebate into the gross grant equivalent, as well as the part of the loan, subsidized loan, also calculate the grant part, and we respect the rules, like if it is SME and do R&D, it like 50, 60 or 70% of the eligible expenses, we take this into account. And in future, what we plan to do, we also plan to use Article 14 of the JIBA for our new measures of the new programming period. And we think to finance the investment of the different kind of investment of the companies, and also we are thinking of using a little bit grant element by Article 14, and also combining Article 14 and de minimis rule. And under de minimis rule, we plan to, as a grant element, to finance preparation work, like different kind of audits or etc. And maybe in some cases, because the purpose of certain measures is to create a workplaces. So under the de minimis, we plan to give a grant for the companies in order to prepare workplaces. And the biggest amount of a loan is like investment loan are going to be financed using Article 14. So that's our experience and plans for combination of grants and financial instruments.
Great, thanks, Ieva. Sounds interesting, but I guess quite complicated at the same time, perhaps from a state aid point of view. I don't know, Joachim, would you have any reflections on that? I mean, it's I don't want to obviously put you on the spot, but maybe you have some thoughts as to.
I think it's a good example indeed of remaining with this gross grant equivalent or transparent aid concept of how you can combine instruments. And indeed, for example, if you would have a loan of let's say 1 million, and there's a grant, there's a capital rebate of 250,000. So then for the GGE of the total loan plus capital rebate, you just would take the GGE or the gross grant, the 250,000, and then of the GGE of the subsidized loan, you would only base it on the 750,000, so that you kind of make sure you capture everything, but you double count. So indeed, good example.
And both of those would then be looked at within the context of one of the JIBA provisions or whatever, right? Okay, I'm sure we must have some questions coming in. I have a few pre-cooked ones, but it's probably always best to see what we have from the audience.
Yes, indeed, Frank. Hi. Yes, we've got some good questions. Maybe we've got two on a similar point around accumulation, so maybe I'll ask those first. Somebody has asked, a capital grant under regional JIBA aid and reduced interest loan. Is the reduced interest aid on the financing cost accumulated with JIBA investment aid or not? And somebody else has asked, how would a capital rebate on a guaranteed loan be treated? Accumulated from a state aid perspective, question mark.
On the regional aid, so here also, if we have maximum aid amount, so then indeed both the rebate part and the subsidized interest part to the GGE of these would have to be added, and then the sum of the two would have to fit under the would have to stay within the limits. Sorry, the second question, could you?
It was about a guarantee. So how would a capital rebate and a guarantee be treated?
Yes. So that could be technically a bit more difficult. So I would say then the guarantee should only cover the part of the loan, I mean, net of the capital rebate, because that would seem a bit strange to have a guarantee on the rebate part, which is also then subject to the company's somewhat discretion or action. So I think if the guaranteed part would be only on the loan, which is so net of the capital rebate, then there again, depending on the guarantee premium, you can calculate the net present value of these if they are below market guarantee premiums, calculate the GGE, and then you would take the grant amount of the capital rebate.
Maybe just on that point about you would find it strange that a guarantee would cover the repayable part. I mean, I'm just wondering from the point of view of the banks, obviously, that would probably be involved in this. And maybe looking at the example that Ieva mentioned about sort of a 10-year loans in some cases where the conditions for moving something from the loan to the grant part, if it's a capital rebate, may only occur, let's say, in year 10. So I would imagine that in that case, maybe there would be a need for the guarantee on the repayable, on the non-repayable part, or the part which is repayable until it becomes non-repayable, if you see what I mean.
Yeah, indeed. I mean, if it's let's say the trigger for the capital rebate is, I mean, there's also it's 10 years down the line, so there's somewhat a market risk, or it's really the company does best effort, but there's just uncertainty about it. Indeed, there could be scope for a guarantee, but to calculate then the GGE of that, not straightforward. I'm afraid that I don't have the answer now.
We'll keep a note on it. There's anything else?
Yeah, well, that actually picks up a point that's been asked by Stefan Ochestu. Thank you, Stefan, for the question. He says, can the GGE calculated initially be modified during project implementation in order to reflect the real aid received, e.g. no capital rebate was received in the end?
Yeah. No, that's always the concept understated, is that at the moment of granting, what has been approved or what is made available should be counted. So then even if it's, let's say, unused later on, that doesn't, you cannot, let's say, retroactively undo the aid granting. So that's the possibility for a capital rebate. You have to fully account it at the beginning.
And you wouldn't be able to take account of some sort of probability of that occurring and say, if there's a high probability, then of course it can be regarded as a grant, and if it's...
Yeah, I mean, there's also the possibility, for example, then if we treat a capital rebate, I mean, as a repayable advance, there's also the possibility for member states to notify to the Commission a method of how to calculate the gross grant equivalent inherent in such a rebate. So there is a possibility to do that, but then it's we are going over. Transparency aid approach, to have a simplistic approach, we would just take the entire amount. Or if you really have an approved methodology, which ensures there's a robust calculation underlying the gross grant equivalent, then it can be done, yes.
Yeah. Could you maybe expand on the, I mean, you mentioned notification, and I think some managing authorities, some member states are probably thinking about this in order to be, let's say, get legal certainty on the concept. I mean, you just walk us through, for those that have actually may have not gone through this process, what's involved, how quick do you think it is? I mean, do you in the Commission, for example, would there be any way of looking at this on a fast track process, or somehow prioritize these sort of applications? I don't know. I'm just exploring ideas, but maybe you can give us your thoughts on how Comp would sort of react to this.
Yeah, no, indeed. So if there would be some combined financial interests with the grant part exceeding de minimis, or so no, member states are always welcome to come to us, and so not necessarily also with a ready notification, but it can also be for very informal pre-notification contact, so that we really could exchange on an informal basis. So member states present their ideas, we then give comment, that we really kind of reach an approach which we deem feasible then to approve in a decision. So if there would be an individual decision would be required, and so there are different, so it would require then a formal notification. I don't think a fast track would be, because it's normally reserved for crisis measures or under the temporary framework. So it would follow the normal procedures. Here's also the question. So JIBA clearly, so if you go out of JIBA and it's about financial instruments, so it remains the same in the setting of a scheme set up with financial intermediaries and private co-investment. So then we could discuss it under the risk finance guidelines. So there, in my opinion, there's nothing preventing us from doing it under the risk finance guidelines, but it's also true that the risk finance guidelines, they kind of have already predefined, let's say, deviations from JIBA, how we look at it. And it's true that so combined instruments are not really mentioned. So it's true that it's probably would require us really to fully think through it, let's say, starting a bit from a white page. It might also be then that the notification is better treated directly under the treaty, so as a kind of a novel measure, if maybe the risk finance guidelines is not so helpful. So I think it would take some time, because it would be a quite novel thing, but we are happy and open to look into this and really engage into contacts with member states. So I think the best is really to approach us in an informal way for pre-notification, because then it's really informal and it can take any direction.
Very good. Thanks, Joachim. I think we have time maybe for one more question, if there is.
Okay, yeah, thank you. Well, this is picking up on that theme in a way. Somebody has asked, do the Commission plan to amend the financial instrument JIBA articles to include the possibility for combination financial instruments? And they comment, this would be a great help.
Yeah, I think, to be open, we don't have set plans, but there will be another JIBA amendment, and that's my personal view, that true that the JIBA currently doesn't allow it, but that from a risk finance perspective, I think it can economically be justified. But then we would need to think through all the necessary safeguards to put it into JIBA, because JIBA is simple, and we really must be confident that because also the three-layered structure, so we need to ensure that aid at the level of the financial intermediaries, at the level of the private co-investors, at the level of the eligible undertakings is proportionate. Also, it's a novel thing, so we need to think through how we can then, how this grant component is channeled. So I think my personal view, it's something which we should internally put on the table, but I cannot say how that's
how easy or not it will be to do. But did you say there will be a review of it at some point? Of JIBA?
Yeah, I mean, the JIBA expires at one point, so then there is, I think now has been prolonged until 26, if I'm right. So, but then the internal works always start. I mean, it's a multi-year process to revise the JIBA, so that's.
So you may already be coming out for consultation, as it were, starting next year or something like that.
I think that would be a bit early because I think there's also lots of internal work to be done first. But I think internally we are slowly
thinking about it.
getting.
Okay, I'll give maybe, I don't know if the colleagues from REGIO want to say anything on this, or shall we close the session?
No, we can go move on, Frank. Thanks.
Okay. Thank you very much then, Joachim and Ieva, for your contributions. And thank you as well to the audience for the questions.
Thank you.
Thanks a lot. And indeed, we are doing well for time. So congratulations for everyone on that too. So we move on to the next topic, which is the form of the financial instrument and grant package. And indeed, we're moving into the second overall session, which is more focused now on implementation rather than design and setup. And for that, I introduce you to a couple of colleagues. One from the European Commission, Oana Dordain, who will be, she's Deputy Head of Unit in the same unit as Jonathan Denness, who will give us a presentation to kick off. We then also have Olivier Dumoulin from the European Investment Bank, Investment Platform Advisor. And last but not least is Ieva Petkova, Director of the Sustainable Cities Fund in Bulgaria. So welcome to the three of you. And without further ado, Oana, the floor is yours.
Thank you very much, Frank. Good morning, everybody. So I will kick off and I will give to you the perspective of the combination from the final recipient view. So if we go to the next slide, so what is also important, as we said at the beginning, the rules for financial instruments are applying also to the grant component. So it means we don't do any refinance through the financial instruments. So Article 58.2 applies. So it means that we'll give the grant at the financial instrument part for the investments which are not completed yet, or parts of the investments which are not completed. After the bank will do its due diligence of the request from the final recipient to be financed, and based on this due diligence or based on the needs of the final recipients, the bank may agree to give already a grant percentage from the beginning. So this is the simplest way to do it, that the banks know how much grant will be part of this financial package, and the final recipient will know from the beginning how much it has to be paid back. Once there is an agreement between the parties, of course, they will have to sign a contract. So the final recipient will have to sign a contract for the loan and the grant. This may be in one agreement, so or it can be in two agreements if the national law imposes so, or if there is, for example, as we said at the beginning, that the holding fund is managing the grant and the specific fund is managing the loan. So it depends really how the member state is organizing it. And it is also very important, and Daniel said it at the beginning, of what the managing authority wants to achieve. And based on what the managing authority wants to achieve and the policy objectives to be achieved, it should be made simple for the banks and the final recipients to administrate. So we are keeping repeating it, but it should be really simple to ensure the framework in which all the actors are acting in order to, in the end, achieve the policy objectives of the program. So now Olivier will explain to us a bit how the grant component is done from the financial recipient's perspective. Thank you.
Yes, good morning. So I will continue to describe a bit the mechanics and what were the outcome of the discussion during this Knowledge Hub. So if we move to the next slide, please. So this is something we have already discussed a few times this morning. about the trigger of the grant element, and in particular when it is a capital rebate combined with a loan. So there are two possibilities if there is a holding fund involved or not. So this can be typically a non-cash movement because the loan would be converted into the grant. We'll come back to that. Or if a holding fund is involved in the structure, there could be a management of the capital rebate by the holding fund and a payment by the holding fund to the bank, or potentially also to the final recipient. It was underlined during the knowledge hub that this criteria should be defined in the funding agreement. This is the simplest way, but in case that there is a funding agreement covering a number of financial instruments, the details can be defined in other binding documents if it's practically more easier to implement for the various bodies. Then these criteria should be defined further down the line in the finance contract, which are signed with the final recipients, so that there is full clarity on the basis on which the capital rebate will be triggered, and obviously of the magnitude of the capital rebate. So this criteria, we have said it again, but this is key for the implementation, should be objective, evidence-based, and easy to manage, notably for the banks, to reassure them that this will not create additional burden on them. There was also a question already raised this morning about the mechanics in terms of accounting of how the loan can be converted into a grant element. So we think that this mechanism is quite simple for the bank. It's a write-off of part of the loan that should be applied in their accounts, but there is still the possibility for the managing authority really to discuss with the stakeholders on the market what would be the easiest mechanism to be applied. So there is still room for discussion here. Now we discussed the capital rebate, but there is also another type of grant that is still very interesting, and especially in this context of rising interest rates, is the interest rate subsidy. So this combination, as you know, was already possible in the past period, but continues to be so. So a possibility that was discussed during the knowledge hub is, for instance, in case there is a holding fund, for the holding fund to pay the interest rate subsidy to the banks on the basis of request, then can be on a quarterly basis, for instance, and which reflects the interest paid in the period. Now, if we move to the next slide, please. So in terms of capital rebate, nothing prevents you in the regulation from having a rebate which would be implemented at the contract signature. That might sound a bit outward, but it's possible, and it would be done, for instance, if the criteria for the rebate are fulfilled ex ante. So you could have, for instance, a rebate provided to lower income families for energy efficiency investments, for instance, and then once this criteria is checked at the beginning, you could already trigger the capital rebate. Now, the rebate might be used in the case of more complex investments where you need to check the performance before you trigger the rebate. And then the way this performance will be checked is a key question. So generally, what is recommended by participants is to keep these checks relatively light when it's possible. So typically for standard investments. But when it comes to more complex investment, then there would be a need maybe for more elaborated checks. So you can have an assessment ex ante, for instance, of the expected performance of the investments. So in the field of green investments, you can use IT tools such as the Green Checker, which was developed by the EIB, and then you can check later on the delivery of the investment. But in other cases, if the banks, for instance, which are involved in the financial instrument, do not want to take this responsibility, they may outsource this to external experts, such as public sector agencies or potentially private sector experts. And this has been done, I think, in the past period, where capital rebates were funded by other sources of funds. So this is also a possibility. But generally, these checks should be really proportionate to the complexity of the investments and just try and facilitate the life and the work of the bodies implementing the financial instrument. Frank, back to you.
Okay, thanks a lot, Olivier. I think before we get into questions, we also wanted to have some reflections from Ieva Petkova. So maybe Ieva, your thoughts on how this would apply in the context of your particular instrument that you have been managing and ones that you're wanting to develop going forward?
Thank you. First of all, we were probably among the most vocal supporters of combinations of support in one operation, probably because in the current programming period, 2014-2020, probably a large part of the practitioners know that Sustainable Cities Fund manages urban development funds for Sofia and southern Bulgaria, and we have implemented and are in processes financing and implementation of over 40 projects in combination of support in 2 operations. And the main problems that we encountered during their implementations made us so decisive to require another approach to this combination. Because first, we really have seen that the combination of support is quite important for the project initiators, for the final beneficiaries, that especially for certain sectors as energy efficiency, renewables, social or sports infrastructure, it's much needed. And as well as for municipalities, especially in less developed regions, it's very important that the loan burden is not very extensive and they really can't cut their ties with the grant support. On the other part, when a capital grant, as in our case, is combined with a financial instrument in the current programming period in 2 operations under 2 separate contracts, it really entailed a lot of problems and a lot of shortcomings have been seen. First of all, there are substantial delays in the approval and the subsequent implementation. There are much difficulties in the management of the financial flows from both forms of support. So what the CPR, the new flexibilities were introduced, they really addressed these shortcomings, and we welcome all that the Commission has done in this direction. The Bulgaria is a little bit really enthusiastic about this combination of support. In fact, in our partnership agreement, this combination has been set, and yesterday was signed a partnership agreement between the managing authority and the fund of funds for the regional development program. And yes, the combination in one operation is foreseen for the urban development funds. On our point of view, because we would like to continue with our experience with the urban development funds, we are really thinking about this combination and what sort it will take off. So because our portfolio is not only energy efficiency, you know, the urban development projects may be both energy efficiency, but also electric mobility, urban infrastructure, other forms of support. So yes, the capital rebate is probably the most bank-friendly form because the Sustainable Cities Fund is comprises both public institution and a private bank, and we are having our internal talks and discussions on this. And yes, this capital rebate is a good form which may be applied to a certain part of the projects in our portfolio, but in the partnership agreement is envisaged both capital grant and technical assistance grant. So we should have all this in our future agreement set in place. And as far as the grant, the capital grant is concerned, yes, there are certain reputational risks that made our bank quite reluctant for the provision of a grant on the level of the financial intermediary. We have a holding fund, the fund of funds, which may take this role, and they may be problems later if these two contract structure is once again quite complicated, as it was in the current period when it's in two operations. But this knowledge hub and all recommendations that you are giving now is giving a more clear track for the future. And I think that the decisiveness both on the part of the managing authority, on the fund of funds, on the financial intermediaries part, will make good progress on this, and will, in the following years, when the new financial instruments are structured, this will be set in place for sure.
Thank you, Ieva. It's always good to hear the views of the practitioners, as it were. The problems on the ground are multiplied to a certain extent. And interesting, you mentioned that the banks, in the cases where you do work with one bank at least, they seem quite nervous about this concept of managing the grants. I think as well we may have some questions online going in this direction. Des, is that correct?
Yes, Frank, we've got a couple of questions about how this works for banks. Somebody has asked, the capital rebate may be great for a bank. However, what admin checks are required from a bank's perspective? Eligibility checks, pre-financing and state aid, for example. And somebody else has asked, how are banks to be compensated for the loss of income which will occur due to a rebate at the earlier stage of the loan repayment?
Right, yeah, good questions. Perhaps I turn to the Commission colleagues for a quick response. Oana?
Yes, so what checks should be done for the grant? The checks to be done should be foreseen in the funding agreement. This would be the cleanest way. So if there are certain criteria to be fulfilled, it should be clear how these criteria should be used. If you have a simple scheme saying, I support SMEs in this sector, and if the SME has up to 3 employees, for example, and for this I give 5% capital rebate, this would be automatically check given by the bank. So the bank, when they give the rebate, they will have to check these conditions. If so the eligibility criteria, let's say, as they are defined upfront, they will be the same as for the loan. So the bank is doing already eligibility checks for the loan, so the same should be done for the grant. Regarding the state aid, the scheme, it is the responsibility of the managing authority to set up the scheme state aid compliant. So it means that maybe certain checks have to be done by the financial intermediary, but the calculation of gross grant equivalent is done upfront, and after it will be a question of reporting, and of course the bank will have to check if it's under the minimis, that the conditions for the minimis are fulfilled. So I would say the checks to be done for the grant component are more or less the same as for the eligibility of the loan. And please do not forget that we are paying management cost and fees also for the component, the grant component of the support. And the question regarding the loss of the income, I do not really see where is the point, because the grant as such will be financed by ERDF funds, so by the national support, so it can be ERDF and national co-financing, so it will never be the grant financed from the resources of the bank. So it is given upfront, it is known, so the bank, we do not expect to have any loss because of the grant. I don't know if you want to complement.
Yeah, no, I think that addresses, I think, the question. Indeed, as you say, we would expect that the grant component, even if it starts off as a loan as such, it would be ideally funded by by the cohesion funds, in which case the bank doesn't need to pre-finance this element and charge interest, etc. I don't know whether the question might be related to a scenario where you have a guarantee with a capital rebate, but I suppose in that scenario, you may still want the capital part to be a funded piece and the guarantee to cover the remaining repayable part, the loan part as such, right?
Yeah, because for the guarantees, we are paying, so the Commission is paying the grant, we pay the grant and the eligible expenditure for the guarantee. So it means proportional of the loan. So if part of this loan is a grant, the grant is covered by the EU budget, and the loan will be, the eligible expenditure for the loan will be proportionally reduced. So in reality, there is the risk for the bank will always be only the loan and not the grant component. So there will be no losses.
Yeah. I mean, it does sound like in all cases you would want to segregate these components and always, or where possible, use the grant part, whether it's a capital rebate or a capital grant, always funded with the structural funds, as it were, to avoid this problem. Okay. Any more questions, Des?
Yes. I think we're getting several questions. I don't know if it's from the same person, but it's all about the mechanism with a portfolio guarantee and a capital rebate. I think they're sort of raising several points around the fact that portfolio guarantee is on a portfolio basis, whereas the grant is individual. So is there issues for state aid or conflicts of interest? And I think it's probably the same person who's asking, what about if the final recipient doesn't reach the trigger? Does that cause an issue for the guarantee? I would describe the whole question is how does a capital rebate work with a guarantee, a portfolio guarantee financial instrument in terms of a capital rebate? Maybe that's the easiest question to ask at this stage.
Yeah, it does sound like we sort of a pickup on the very last point we were discussing there. Oana, you want to reflect? Also, maybe Olivier, you have some thoughts?
I don't know, Olivier, you are a banker, so you can start. I can give my administrative point of view, but maybe Olivier is better placed to say.
Yeah, what we said in our previous publication on that was that indeed to avoid the double financing, so that we cover the capital rebate with the guarantee, we should ensure that either the guarantee upfront does not cover the capital rebate element, or that it is reduced when the capital rebate is triggered. That would be the approach. The easiest one would be obviously that upfront you do not cover the capital rebate. But as Oana said, what is important is in the end that the eligible expenditure which is discussed, which is declared to the Commission, does not exceed the eligible amount of investment. So that's possible. And regarding just the granular portfolio of loans, it's important that to keep in mind that this grant intensity will be calculated at the portfolio at the instrument level and not instrument by instrument. So you need to check the balance before that, and you can have different grant intensities at project level, provided this 50% rule is not exceeded.
Yeah. Oana, do you want to comment, or I?
Just maybe to complement from the eligible expenditure point of view, I think, I mean, fully agree with Olivier, but you should not be scared about these guarantee instruments, and we wanted to make it very simple. So in fact, from the Commission perspective, the managing authority will give to the guarantor a certain amount of money and will say 20% of it you have for grants and 80% you have for loans. And I want a multiplier at 4 for the 80%. So after it will be a bit the work of the guarantor to manage this amount. And it is their practice to see what is the risk of portfolio, to adjust the risk of the portfolio and so on. But they should keep this general line like 20-80%. Yeah. So it's and after they do, as Olivier explained.
Yeah. No, I think that's right, and I think Olivier, the sort of two ways of doing it. I also do probably think that it would be easier to keep it separate from the start, so that the guarantee does not cover any part of what might become a grant in the future, to avoid some of these issues that I think, you know, whether it's sort of loss of income or these uncertainties that come with this element of whether it becomes a grant or not. I think this should be funded, and maybe also just to highlight, it's a very obvious statement, but sometimes worth saying anyway. I mean, now that we actually treat the grants under the financial instrument rules, it obviously means that the intermediaries can get the money up front, so that essentially the project can be funded from the start. I think sometimes people still work in the mindset that the grant is some sort of reimbursement mechanism, and that's why maybe these sort of concerns come up, that they think the project needs to be funded with a loan to start off with from their own resources, and then there'll be a grant coming later. That's certainly not the case. The grants can be, as you said, Oana, there could be a pocket of grant given upfront to the intermediary, and that is what they use actually to make, for example, a loan at the start, which then becomes a capital rebate mechanism later on. Yeah, I mean, picking up on the, I'll turn to Ieva there. Ieva, if you can come back online. You mentioned that the capital rebate you thought was going to be best. However, we hear sometimes that capital rebate means that someone has to do some really tricky sort of eligibility checks, and it's all conditional on this, that, and the other. Any comments? I mean, why would you see the rebate being more preferable to the simple capital grant approach?
Because it is more obviously based on objective criteria than the capital grant. If the capital grant we envisage to be calculated only on the basis of the business plan and the calculation of the viability gap, when we have, for example, a capital rebate that is triggered upon achieving a certain energy class, as we are foreseeing such scheme for energy efficiency, and when the post-audit confirms the achieved class, it can be a quite clear and objective trigger event for such a capital rebate. And that's why we think, especially for energy efficiency, this is a very nice type of combination that can be easily implemented and really give a push to more energy efficiency projects happen here in Bulgaria, because we are really lagging behind in this sphere. That's the reason why the capital rebate seems quite easily to be implemented compared to capital grants. Of course, still these state aid considerations and the threshold under de minimis are a bit, now. And we know that the state aid is, one of the biggest concerns once we really want to implement something new in the sphere of financial instruments. So we should really be careful in that sphere, and we should start from now to work on the state aid and how this combination really can happen in the urban development funds portfolio and the scope and project budgets, because we really finance bigger projects, and if the threshold for the minimis of 2,100 euro should be met, it will be quite difficult to be implemented in the way we envisage it now. And yes, probably it will be easier for the bank to administer such kind of combination of support. The reputational risk that our bank is seeing now is less than in the other scenarios. So probably this will be one of the direction of combination that surely will be implemented and can be implemented in a much easier way and in a timely manner. While on the capital grant part, we should have more discussions and thoughts how such combination may be delivered in such a way that it will be easier for the final recipient, easier for the financial intermediary, and the managing authority can have all the trust in the system that everything is in the best way implemented.
Indeed. Yeah, thank you, Ieva. Des, I think one more question came in.
Yes, just it's a nice quick question, and it relates to something in the notes, so I will ask it. It follows on from the discussion about guarantees and capital rebates. If the guarantee covers 80% of the operational capital of the operation, the capital rebate should be no more than 20% of the investment, I understand. Is that right? If the guarantee covers 80% of the operation, is the capital rebate limited to 20% of the investment?
Oana?
Yes, no, not really. So it is not, it doesn't work like this because from the Commission perspective, so what is eligible expenditure and what the managing authority should take into account is that if we give guarantee for an investment of 100 and we guarantee 80%, we cover a loan of 100. So in reality, okay, the eligible expenditure will be, let's say, 20 for this guarantee of 80% for the investment of 100. So from the Commission perspective, the entire loan is subject to the rules of the CPR, because if not, it would have not been supported. And we have a specific terminology in the CPR saying that we refer to the investment supported by the financial product. So in fact, the grant has to be compared to the entire investment of the loan. Of course, if you want to give a loan so if the investment is 100 and you cover, you give a loan of you cannot give a loan of 100. Yes, let's assume the investment is 150. Sorry, because I was confused by the question. So if the investment is 150 and you want to cover a loan of 100, you will give a guarantee of 80% of 100, but the entire 100 will be covered by this guarantee. So you have 50 as grant, because the full investment is 150. So you have to compare for the rules in the CPR, the 50 with a total investment of 100, which is warranty. Yes, so we are still in the rules. So it was more from the perspective, you have always to calculate based on what is eligible expenditure. If you give a guarantee of 80, but your loan, if you have your investment of 100 and you give a loan of 80, you will have to cover 80% of 80, yes? So you cannot take 80% of 100 and to say, I give a loan 80 and the grant 20 and I cover only, because I covered 80% of 100. It doesn't work like this. So your guarantee will be based on the loan which you are giving. So if in a loan of 100, you give a grant of 20, you remain with a loan of 80, so you cover 80% of 80, and this eligible expenditure will be the multiplier for the loan of 80 plus 20 grant.
Yeah, I think that's clear, and in a way it picks up on the points we were discussing earlier, right? So to divide, I think the part that you're funding with a loan and to which the guarantee is attached from the part that essentially you envisage to become a grant, whether it's a grant up front or a grant rebate mechanism, let's say. And indeed, you would not want the guarantee to cover a loan which is somehow financing that part that should be declared as the grant element, because that is indeed, as you say, the double financing dilemma. And I think that also works well, it seems, with the discussion we had earlier with Joachim on the state aid issue, where we had this question of how would you combine the gross grant equivalent and the guarantee with a grant. It's the same issue, I suppose. You would want the gross grant equivalent of the guarantee to be somehow only for that portion that is not actually covered by the grant, and that we wouldn't envisage a scenario of actually having to pre-finance the grant with some form of loan that is not funded by the EU funds.
Yeah. It would be for sure a double financing if we start playing with these guarantee rates and so on. It should be clear, separated. Whatever is done, it should be separated. And of course, as Olivier and Frank, you said, the easiest way is from the beginning to decide, because you can do it after, but you will have to adjust all your accounting to show that the moment you activate the grant, you decrease the eligible expenditure for the guarantee. So.
Very good. We're a little bit over time, but I think that's fine because we actually do have a bit of space at the end. But let's anyway move on, if that's okay for everyone. Thank you very much again to Oana, Olivier, and Ieva. So we move on to the next topic, which is the application of the FI rules to the grant component. And for this, we have, again, two colleagues online, Theodosios Sampaniotis, Policy Officer in DG REGIO, who will give us a short presentation on the topic, and also with some comments from the practitioners on the ground. Ieva from Lithuania will be back to join us after that. So without further ado, Theodosios, over to you.
Thank you, Frank. Thank you, Frank. Good morning from me also. So part of the discussion in the Knowledge Hub centered on the meaning of the provision contained in Article 58, paragraph 5 of the CPR, which states that where a grant is combined with a financial instrument in a single operation, the rules applicable to financial instruments shall apply to that single financial instrument operation. Well, simply that means that at all times, the rules in the CPR relating to the financial instruments apply from the stage of the examination up to audit to both the FI component and the grant, when of course they are combined, as we discussed here, in a single operation. Now, the expectation was that this will significantly facilitate the implementation of combined operations. The opposite, having each part follow its own rules, negates the whole idea of a combination in a single operation anyway. Now, in the discussion, some of the participants also expressed that in the organizations, let's say, there is some reluctance to fully commit to this principle, and we hope today that this discussion will facilitate the implementation of combined operations. So, to get into more details, the articles in the CPR concerning grants do not apply to the grant component in a combined operation. That means that Articles 53 to 56, which concern the form of grants, the flat rate financing for indirect costs, direct staff costs, or the flat rate financing for eligible costs, do not apply to the grant component. There was a discussion in the Knowledge Hub between whether the simplified cost options approach should be adopted for a grant FI combination instruments. It was, in the end, the conclusion of the discussion was that the use of features such as flat rate grants may well be part of the combined operation, but the specific requirements in Articles 53 to 56 do not apply to the grant. That means that when the managing authority is designing a combined operation, they may draw on models for inspiration, but they have a greater flexibility to design these products tailored to their needs and the market needs. So you can use them, but you don't have to follow every specificity in the articles of the CPR of 53, 56, because it's no longer a grant. Also, for Article 65 on durability does not apply. It's always specified in the article that it doesn't apply for financial instruments. Article 67 on specific eligibility rules for grants, contributions in kind, depreciation costs also don't apply. What does apply to the grant component, as well, of course, the FI component, is the articles on financial instruments, which means Articles 58 to 62 that deals with the ex-ante implementation, direct award of implementation, funding agreement, the articles on how to use interest generated and other gains, and the differentiated treatment of investors, and also the reuse of returns, of resource return, which of course we are talking here about grants, so it's not so much of a use, but okay. Article 68 also on eligibility rules for financial instruments apply, including implementation across consecutive programming periods and management costs and fees, which on the latter we will return a little later. Also Article 81 on management verification and audits, for which we will talk also later. And Article 92 on payment applications, basically. All these articles apply also to the grant component of the combined operation. So the grants benefit from the more flexible financial instrument regulatory framework. Positive implications include, for example, that the application process for financial support can be more simplified. Also for the project assessment, and that's a benefit both for the final recipients and of course the bodies implementing the financial instruments. Also the disbursement of funds which can be made in advance by the body implementing the financial instrument can be made directly to the final recipients or for their benefit, of course, and that includes also the grants. So you can have an advance paid on the grant, not only the financial instrument component. That's important. If we want to focus a little bit on management costs and fees, as said before, it's Article 68, paragraph 1D, that applies to both grant and financial instrument component, meaning that the total amount of management costs and fees paid to financial intermediaries will be calculated on the sum of the grant and financial instrument component, something that makes possible the compensation of financial intermediaries, implementing the combined financial instrument, of course, for the additional management costs for the grant component. It's important also for the financial intermediaries because it's an incentive for them to manage the grant component. So, of course, when there's some differentiation on whether or not the financial intermediary has been selected through a competitive process, which in such case the fees then can be set based on the market conditions and etc. If there has been a case, if we have a case of a direct award then the eligible management costs and fees are subject to the threshold as described in the Article 64, paragraph 4. And here, of course, again, to emphasize that these percentages in this paragraph apply also to the grant component. So the funding agreement can be structured so that the management costs and fees are performance-based, and this means that performance-based remuneration, which might be defined on achievement of milestones or objectives related to both grant and the financial instrument components. There was a discussion on how the thresholds work if the trigger of a capital rebate is after the end of the eligibility period, if there will be any impact. But it was confirmed that in the case of a capital rebate, the date at which the rebate is triggered has no impact on the level of management costs and fees. And I think there was also the numerical example in this note, or maybe I don't remember, maybe in the previous note, of how it works with guarantees and capital rebates, which explains in more detail how this doesn't really make any difference in the level of management costs and fees. I think we covered everything, but I will turn now to Ieva to give us her views on if actually all this facilitate the implementation of a combined operation, or we need to do more.
So yes, I think it will help us really, because from our previous experience, we had a very good financial instrument. It was loan for SMEs, for startups, when they had to go to the financial intermediary to get the loan, and they were evaluated, and after getting loan, they come to us, to Invega, for the grant component. Again, all the evaluation and other process, and of course, the collecting of supporting documents. What I hope we'll have now, everything under one agreement and under financial instrument rule. And the best is that we will not be obliged to gather all those supporting documents. And what we hope that we would get the best of the to be used rule. And the financial instruments really rules not applying the grant rule really, I think, would help us.
Very good. Thanks, Ieva. And thanks, Theodosios. I might just ask Arta or Victoria just to put the slide back on in case someone has lost contact with that while we discuss the questions. I think there is one question in, right, Des?
Yes, a question from a financial intermediary, actually. And I think they're asking about whether combination would be an additional burden on the bank. The question is, FI eligibility criteria are already very complex. Should we expect more criteria / overall complexity concerning the grant component? is that an additional burden on the bank?
Theodosios or Oana, perhaps, I don't know, someone on the
Theory, I can try and Oana can compliment if there's some more need. In theory, since we're talking about the fact that financial instrument articles apply all to the grant component, we shouldn't have any differentiated criteria of eligibility or anything like that. Of course, when the managing authority is designing the product, the combined operation, then they sign the funding agreement with possibly and preferably with one, not only one bank, sorry, not on a financial intermediary, but for a holding fund and then a series of funding financial intermediaries. The details there will not be more than needed for a single financial instrument. Normally, it shouldn't be the case. Of course, when you have capital rebates combined in there, yes, you will have some more explanations when you trigger the capital rebate, etc. But we shouldn't have different eligibility criteria for the grant component and the financial instrument component. There shouldn't be any different, I don't know, checks or something like that. Of course, the fact that they are managing a grant component and not only loss or guarantees for financial intermediary means probably more costs, more work burden in general, but that's why they also get compensated through the management cost and fees. And hopefully that will be enough incentive for them to take over this, let's call it burden.
I mean,
yeah.
Sorry, go ahead, Ieva.
No, it does mean
sorry, Oana.
Yes. I think it is important, I mean, to complement a bit what Theodosios said, it is important to understand that it's not a grant. Yes, I think for financial intermediaries, it's important to understand that we don't speak here about a grant in the pure sense of a grant. So we speak about transformation of a loan in a rebate, so it means the final recipient will have to pay less. So most of the time, and it is our preferred option and what we encourage most. So it means for financial intermediary, they should have clear criteria in the funding agreement on which basis we activate this rebate. Yeah? So banks should not be in general scared by the fact that we speak about grant component. We needed to call it grant component in order to fit into the legal text of the CPR. And we even tried to give a definition when we drafted the CPR to say what is a capital rebate. And we didn't want, because we would have been restricted, because there may be so many possibilities in the market, and we didn't want to choose one or two. So of course we speak about capital grant when we have a financing gap. If there is a financing gap, it's the role of the bank based on the investment to see how much is the financing gap. It's their daily business, yes, because based on this, they give the loan. So it will not be additional burden. Where it may be additional burden, if you have a grant based on the cost, so if you reimburse a cost. And in this case, we are not encouraging this possibility. It can have a role or it can have a purpose in certain situations, but there, of course, if we say we give you a grant because you have to buy a tractor or you have to buy machinery, and we want that you buy this machinery, and we give you the grant for this machinery, we suppose that it should be proved that the machinery was bought and you give the grant. So this would be a pure grant in the sense that you can have an invoice or a cost or something. It's not what we try to promote here. We try to promote here simple rules for financial intermediaries exactly in order to avoid this over complexity.
Yeah. No, I think that's clear, and indeed you gave an example of how grant as such would be treated vis-a-vis what we're trying to do here. As you say, maybe we should think of this as a non-repayable financial instrument component rather than a grant.
But legally, we cannot define it as such.
Indeed, I understand. Des, I think there was one more. Are you there?
Yeah, I'm here. Sorry, another nice question. Thank you. Somebody's asked, how can compliance with Article 58.7, sentences 2 and 3 of the CPR be guaranteed in real life? And those two sentences are the ones that say grants shall not be used to reimburse support received from financial instruments, and financial instruments shall not be used to pre-finance grants. How can that be guaranteed in real life?
That has been also a question that has been discussed, I remember it was in this knowledge hub over the previous one. How do we avoid double financing, but also how we avoid exactly this breaching this rule that says that the grant cannot pre-finance a loan, financial instrument cannot pre-finance a grant. Sorry, I got a little confused there. The answer is that when we design the financial instrument, sign the funding agreement, and then the financial intermediary signs a contract, let's say, to give a loan with a capital rebate. When they may sign this contract, they have all the specifications there of what is the loan, what is given for, and what are the triggers for the capital rebate. In this case, we avoid calling the loan a pre-financing of the grant because we take the decision at that moment and we explain the rules, we explain what will be used for. So in the end, the eligible expenditure will be for specific investment. So there will be no double financing, and there is no, we cannot call it, at least legally, a pre-financing of the grant. But all this is done because when we sign, the financial intermediary signs the contract with the final recipient, they specify all these things in the contract. So there is nothing, there is no risk of double financing, there is no risk of pre-financing. So that's a critical point in the implementation of a combined financial instrument operation. They are not two different operations that they need to somehow make sure that happens at the same time or whatever else. We have a single operation, everything happens at the same time, so everything is clear to everyone.
Very good, thank you, Theodosios. And I think recurring message of the day seems to be, you know, let's keep these things separate, even though it is a single operation, but treat them separately from the start so that we avoid confusions maybe coming along later. And I think that also leads us nicely into the next topic, where we actually address the issue of monitoring and reporting and how things are sort of declared in the reports coming back from the managing authorities. And for that, I would like to reintroduce again Ieva Zālīte from Policy Officer from DG REGIO, give us a presentation on the topic and comments potentially from Daniel from Poland. So Ieva, please.
Thank you very much, Frank. And indeed, it's very important that the funding agreement foresees the arrangements between the managing authority and the body implementing financial instrument, how they will communicate the information about how these two forms of support are combined and how they are accounted. If I may have, yes, thank you. In the discussion in the Knowledge Hub, so the participants discussed the situation where it's welcome and important that managing authority and financial security agree how they report on the grants, grant support and financial instrument, which is not yet paid, but will be foreseen in the future. So this information on foreseen grant components is not part of the reporting by the managing authority to the Commission, but it should be available and may help the bodies implementing financial instrument to monitor this proportion of the 50% applicable to the grant. The chain of reporting will be from the, so if we have holding fund structure, from the specific fund to the holding fund, and then holding fund would inform the managing authority. In case of specific funds, the direct reporting from specific fund to the managing authority. Of course, the managing authority has to fulfill its obligations concerning reporting on the use of program resources to the Commission, and these also will be a part of the funding agreement. What is important and also mentioned, grants and financial instruments should be recorded separately. This serves the purpose both for the reporting, the transmission of data, and also for the declaration of expenditure. Important point is that information on disbursed awarded grant elements should be included at the moment when there is a payment, or there is, if we speak about the capital rebate, when the grant, when the part of the loan is actually transformed into the grant and it's written off in the books of the bank. If I may have the next slide, please. Here, which was also discussed by the previous interventions, here in this paper and also in the previous publication, we have this example, and it's recognized as a very good example of how the mechanics works of accounting and recording a grant component in the case of a financial intermediary, and how it is reflected when the managing authority declares, submits a payment application to the Commission, and in the case of transmission of data. In the interest of the time, I will move to the next slide, please. Here, in the discussion in the Knowledge Hub, there was interesting discussion as to how to mitigate the risk towards financial intermediaries in the management of the grant component when the irregularities may occur. So just as a general remark, when we speak, the Commission or the EU budget will never pay for irregularities. This is true now, and it's true for any situation. And the discussion was about the situation where the what happens in case if the final recipient cannot pay the loan, so in the event of default, and what happens if irregularity occurs in different situations, either in relation to loan or first, maybe with I can start with easy case. So there is no regularity at the level of the loan and neither the grant, and both components are eligible for the reimbursement by the Commission. The only problem is that final recipient cannot pay back the loan, so there is no need to call back the grant, but the recovery process of the loan will follow the normal practice of the financial intermediary. Second case was in case of the irregularity that happened at the level of the grant, for example, technical support. So here the loan was regular and eligible and can be reimbursed by the Commission. So in this situation, both grant and loan has to be recovered. Grant because it's not eligible, and recovery of loan will follow again the normal practice by the financial intermediary. And then what happens in case of irregularity at the level of the loan, but the grant is sound and regular. The Commission will not reimburse the grant component, but the Commission will reimburse only the grant component, but not the loan. So this here we will be in a similar situation where the grant component is not followed by the investment, and if the loan cannot be paid back by the final recipient, again the financial intermediary will follow its usual process of recovery. If I may have the next slide, please. And here very shortly, we also in the discussion, the participants touched upon the audit of financial instruments and grant combinations, and it was already also discussed a little bit through the questions and answers. Since grant component follows the financial instrument rules. Financial instrument audit principles will also apply in the same way to the repayable part and to the grant element. So we speak about financial instrument single operation. So the financial instrument rules apply from the start to end. Also, what came out through the questions and answers just before. To check the eligibility of investments, it remains the responsibility of the body implementing financial instruments, and the auditors will ask the financial intermediaries to demonstrate the evidence that they have followed their procedures for controlling the eligibility. So as Oana mentioned, it's important that the funding agreement is very clear about the role of the what the financial intermediary has to do. So, and the very last point, as you know, the 21-27 regulation offers this flexibility about verifying intended purpose, the use for intended purpose to be verified ex ante. So it means that this concept applies also to the combination of grant and financial instrument support. So, and this will be verified indeed by reference to the applications that the final recipient submits, or like business plan or application for loan. Thank you very much.
Thank you, Ieva. Daniel, any reflections from you based on also the discussions we have at the Knowledge Hub on this topic?
Yeah,
from
yeah.
a perspective, please.
Yeah, yeah. In this part, I would like to briefly comment on two issues. The first one is alternative between capital grant and capital rebate in the case of monitoring and reporting needs. In both forms, of course, in both form of grants, the monitoring procedures, the IT monitoring system must allow to track cash flows connected with the payment of the grant part. But it seems that in the case of capital rebate, it can be a little more complicated, because we have to include the moment of the conversion, like in the example presented by Ieva. So when the part of the financial instrument support, for example, loan, will convert into the grant part, and the moment of the conversion has to be reflected in the monitoring system, in the monitoring tables. So it's a difference between capital rebate and capital grants when it comes to monitoring procedures, of course. The second issue is the necessity to monitor the 50% threshold for the grant part at the level of the financial instruments. And again, we can imagine, we can have two scenarios. The first scenario is when the grant part is fixed at the predefined level. In every case, the level of the grant is lower than 50%. And we have a second, more sophisticated scenario when we have more flexible approach to the grant part, and in some cases the grant part can be higher than 50%, for example. And of course, this second scenario is more demanding from the monitoring point of view. The IT system in this case has to enable managing authority to monitor the use of grants at the level of the financial instruments and to react when necessary. The first option, where the grant part is always, for every single investment, the grant part is always below 50%, it seems to be easier because the managing authority from the beginning can be certain that the 50% threshold for the whole financial instrument is maintained during the whole implementation period. So just 2 comments from my side. Thank you.
Thanks, Daniel. And thanks again, Ieva. I think we are running a bit of a time, but not too bad. Maybe we have time for one question here, if we have any. Des?
Yeah. Thanks, Frank. Yes, one quick question. People have asked about how to retain evidence to show that the financing is to be used for the intended purpose. They've asked, will the support be verified by reference to application forms? And does this mean we should not require invoices from recipients?
Okay, well, indeed, the purpose of this provision in the CPR, where we speak about the requirements for evidence and audit trail, was to simplify the way the repayable support is verified and checked. And also to rely on the competence and business practice of the financial intermediaries, because as for a normal loan, a commercial bank will do its proper assessment of the loan, because they will not give money away just like that. So therefore, the purpose was to rely on this, on the practice, and to do verifications and to ask for this evidence that bank has done its job at the level of the business plan or application for loan. It doesn't, so a lot depends what is included in the funding agreement and in the financing agreement with the final recipient. If such financing agreement says that, for example, that we had example about if we if there is a certain machinery bought and the loan is disbursed against the invoice presented to the bank, yes, such evidence will be kept at the level of the financial intermediary. But this will be, again, part of the way the financial intermediary disperses the loan. So if it's in the contract, in the financing agreement with the final recipient, it doesn't mean that the final recipient has to present invoices, but the invoices will be available at the level of the financial intermediary. But this is a specific case.
Yeah, thanks, Ieva. Just picking up on that point, Daniel, any comments from you in terms of how the managing authority, how you as a managing authority would want to pass these on to the intermediaries through the funding agreements or otherwise?
Yeah, it's hard to say anything groundbreaking here. I think all these crucial principles connected with monitoring and reporting needs mentioned before by Ieva have to be transmitted to the banks or to the financial intermediaries. So the whole monitoring and reporting system should look like cascade. Yeah.
Yeah. Yeah.
So nothing new in this topic.
Yeah, no problem. Very good, colleagues. I think we've come to the end of our session, and I thank everyone for persisting with us. It has been a rather technical session, but I think that was actually the point, because clearly there is a lot of devil in the detail, as we always know in these things. But I have to say that as a theme and as a way of doing things, certainly on behalf of a bank that's implementing this is definitely a game changer. and it should be seen as that. And we need to keep our eyes on the end game here. Of course, we have to work through the details of how this works in practice, but I think everyone agrees that this is definitely a very inspirational and new way of doing things. And I would actually like to maybe, before I pass on to Jonathan Denness to close the session, I also just wanted to give the floor again to one of our external panelists. Ieva, maybe from your point of view, again, as an implementing partner, anything you would like to say on closing, final remarks, thoughts, reflections?
I would like to encourage all the practitioners to implement this combination in one operation and not to be fearsome. We've done more difficult part with combination in 2 operations, and though we met a lot of difficulties, it's really worthy to see the results, to see the satisfaction, in fact, in the eyes of the final beneficiaries when a project is implemented. And yes, now it may sound a little bit more complex than we would like, but it's in fact in our hands, in our common efforts to really make these schemes more easy to be applied. And if all the stakeholders, the managing authority and the fund of funds and the financial intermediaries are really on the same page and on the same table, we can push this implementation forward. And I do believe, I'm a believer as a person, that things can go in a positive direction, and that really this combination will increase the firepower of financial instruments, especially in countries like Bulgaria, where though we have experience since 2012, still there are fears. Why should we go forward with more ambition with financial instruments? And I think that this combination, the way it is now structured in the CPR, gives us a lot of freedom to structure in a good way the coming financial instruments, especially for urban and regional development.
Great. Thank you, Ieva. So indeed, this is an extremely important topic. It was demonstrated today. I believe at one point we had up to 340 people online, so it's clearly a topic of great interest. I thank everyone, all the speakers who participated today, obviously all the colleagues from DG REGIO, but also clearly our external visitors from the managing authorities and implementing bodies. Thanks as well to Des for keeping the tab on the questions there. To Arta and Victoria, our administrators on the website there, that thank you as well for them. Also to say that the document that summarizes these discussions from the Knowledge Hub, as Des was saying, is online on the FICompass website. So please take a look at that. You know, these discussions, this dissemination event that we have today, this will continue, I think, as more and more people will want to know how this thing is going to work in practice, and therefore we will certainly have more on this topic going forward. But I stop there, and I would like to hand over to Jonathan Denness again to close the show. Jonathan.
Thank you very much indeed, Frank. And can I add my thanks to yours to everybody who's participated today. It's been a very intense session. It's been quite technical, but that's what we think is needed here. One thing we haven't mentioned so far is that we have produced a couple of financial instrument models, which provide a template for managing authorities to use to set up financial instruments, taking account of combination. There's one on energy efficiency, and there's one on the new European powerhouse, and both of these models are available on the FICompass website. I think if there's one message I've taken away from today, it's keep it simple. So don't overcomplicate your lives. And my final point is that this isn't, as Frank said, this isn't the end of our work on this, because we would really like to know about how your implementation goes. Please ask us questions if you encounter problems that we haven't covered today. And I don't rule out the fact that we may take the document, say in 6 months or a year's time, and see if we can add more to it to help out on the basis of experience and so on. So this isn't the end. This is the end of the beginning, and we remain available to you to help out as you set up these combination financial instruments. Many thanks for your excellent moderation, Frank. It's now exactly 12 o'clock, and we're finishing.
Indeed. Thank you very much. Thank you to all online.